So hi everybody, this is Hustle Hub. I'm Giacomo. Today I'm with Leonardo Cardoso. He has a very special background. So he recently started his own YouTube channel. So Leonardo, thank you for being with us. And let's tell us a bit about what you do, your background, and why you decided to start your own YouTube channel.
Yes, Giacomo, thank you so much for the invite. Pleasure to be here. Pleasure to be with your audience. And yeah, the YouTube channel is more of a project, a consequence of asking to quit from my prior job and starting my own farm here in the U.S. After 20 plus years working for large companies. So the YouTube channel is the beginning of trying to connect more with people and expanding on one of my projects, as I said, which is the educational project, which I had it from NYU.
Okay. So can you tell us a bit about your background and how you got into finance first and how you got into the current roles you have right now?
Sure. I think the beginning of my story, at least, is a little bit unusual from, I guess, most of the people. I'm originally from Brazil. I was born in Brazil, and I actually, found out my calling, I would say, over at an exchange student program, a high school exchange student program coming out of Brazil and going to the US to study at a high school. In one of my classes, which was home economics class, we had to pay the budgets, pay the bills, whatever the envelopes. We had some monopoly money, and whatever was left over, we had to find a stock to invest. And that's how I kind of got myself exposed to the stock market. What I forgot to mention is that I was in a 500 people town called Castlewood in South Dakota. In my high school classroom, we were 24 people, and I come from a couple million, city in Brazil. So I would never thought to be exposed to the stock market in such a small environment, a small class, small whatever. That never occurred to me, the access that we had at the time. And after I went to the library, found out about Disney, which I've been before. I've traveling with my parents to Disney on a typical trip when you turn 15, 16, whatever. And I was like, holy crap, this is Disney. Yeah, I understand now. That's the parks that we went. And now you start studying a little bit about, the parks, the hotels, merchandising. And I kind of fell in love with the whole story about investing. And from that day forward, I think I was blessed to find out that what I wanted to do at a young age, 18, 19. And I started, everything that I did from then until now, it has been with the purpose of being involved in the financial markets, financial industry, in a position of investment decision making.
Okay. So can you tell us a bit about your track record? What were your first roles into finance and how you got where you are right now?
Yeah, the story goes, after I went to high school, I wanted to go back to the US, right? The experience in itself was kind of eye-opening for a kid coming out of Brazil. I'm sure your audience understands Brazil. Everybody European there understands as well all of the different developing markets around Italy and so on. I'm sure it's a little different than the US, and everybody's kind of oblivious to the rest of the world sometimes. And coming out of Brazil and staying in that little town, my eyes kind of opened into the difference between emerging markets and developed markets. The story that I like to say, how I got into this is I remember, recess would come, and by the time, we ate lunch, and then we could go to the gym to play basketball and to have fun. And as soon as we finish lunch, we could, just grab a basketball or a soccer ball or whatever, and we could start playing and have fun and enjoy recess. And I remember, like as it is today, I remember in Brazil, thank God my parents gave me the opportunity to study in a good school in Brazil. We did have basketballs inside my school. However, here's the problem. All the basketballs were locked. into a room, because that's the only way that you can keep it, right? So by the time we finish lunch and we go to recess, we would have to, run to the basketball court, find the guy who has the keys. So, oh man, Peter, whatever, Pedro, he has the keys. So let's find Pedro, and everybody goes look for Pedro. He's probably taking a nap somewhere within the vicinities, right? So we get him to go open up the door, and we run inside. Oh, let's get some balls. Oh shit, the ball is not, it's not working. It's not inflated. All right, turn on the compressor here. Let's put some water. Let's put some air. You turn on the compressor, the thing doesn't work. And you're like, come on, man. It is that hard for kids to have fun. And I think that contrast for me really got me, which is in emerging markets, nothing kind of works, right? Plus, sometimes I took my ball to school and I got robbed on the way to school. So I never took the ball again. I was scared shitless out of my, for my life when two kids come over with a knife and here, give me the ball. And I'm like, oh shit, man, I lost the ball. So so in emerging markets, things don't work. In a small town in Castlewood, South Dakota, everything worked, right? The ball was there, we could play, so we could kind of grow. Excuse me. And that was eye-opening. I said, I have to go back here. So I went to Brazil after my high school year. I couldn't stay there. I went to Brazil. I had to go back. But I had in my mind that I need to come back to the US to go to school. I was determined to go to the university in the US, study finance, which I've learned a little bit about in high school. So when I got back to Brazil, I enlisted in the military. I wanted to have a couple of experiences. Friends of mine said, "Oh, this is pretty hard to do. You get a lot of challenges, and I don't know, everybody complains about it." And I'm the kind of person, the more complaints people do, the more I'm curious to do something. So I end up, enlisting in the military, spend some time. During that process, I was studying for my TOEFL. Finally, I had the chance to apply for a US school. Came here to start university. And after 4 years, I graduated from Florida, University of Florida, finance and economics. And on the last semester of school in the US, we have an employment fair where companies across the country come to these specific schools looking for people to hire. I was interviewing with Lehman Brothers at the time. This was back in the 2000s or before the 9/11. I was kind of ready to go to Wall Street and start my investing career, finance major, as I said, and I didn't get a job with them. I needed to find a way to stay here again for the second time in the US because we have a time limit for our visas. Yeah. And I end up getting a job at Enron, which was the energy producer company that I'm sure you guys probably study.
Yeah, maybe you can. I heard about the story, but for the guys in their 20s like me, maybe they don't know the story. So can you tell us a bit about what was Enron and what you did?
Yeah, Enron. Sure, Enron was a quite interesting. It was my first job out of college, so I was exposed at the time. Obviously, no one knew what was happening and what was going to happen. And Enron was kind of, I think they were the highest flying company within the S&P 500. They were growing like crazy. They were hiring everyone across the US. They were, operations was just going, through the roof because they started to transform themselves from an energy producer in commercial company into a trading company. So I think Enron was outside of Wall Street. If I'm not mistaken, Enron was the largest trading firm outside of New York area. And they were much bigger than some trading desks from New York, just because they were transforming themselves to be a market maker for everything that you can imagine that can be measured and quantified and standardized. So in other words, anything that can have a resemblance of a stock, for instance, they wanted to make a market. And I got a job to help with the industry analysis of Brazilian forest pulp and paper producers. So Enron at the time, they were making markets for forest products. So they would buy and sell cardboards, pulp, paper, recyclables, all of the forest products derivatives in terms of products. And I'm being Brazilian. Brazil is a very big player within the forest industry, eucalyptus producer, eucalyptus grower. So they kind of needed me to do a little bit of research for the market makers. And it was an incredible 6 months, literally, because when we got there, when I started my rotation at the time, we were analysts. We had a rotation program. When I started, that's when it kind of the company started to plateau in, and things started to showing up on the balance sheet. People asking questions, and for your audience, what happens is Enron is the poster child for corporate accounting schemes and corporate governance, because the long story short is that the executives of the company, the high level executives, C-level executives, they were all into cooking the books pretty much, and using Enron's credit to do off-balance sheet transactions, which I'm sure you guys studied. Off-balance sheet transaction doesn't get into your credits, and if it doesn't get into your credit, therefore you have a great credit. You can have a shitty balance sheet, all the junk and toxic stuff, you can put it off balance sheet, and you maintain your credit rating very well. And that was kind of the long stories, right? When they started putting all of those off balance sheet into the analysis, they realized that, holy crap, this company is over leveraged. They don't have the ability to pay. They have a lot of debt, so on and so forth. And the credit rating starting to go down, stock price go down, and it's history now. So you know what happened. The company went bankrupt.
Okay. Can you tell us a bit about what you did and so you were trading commodities. Was it something like trading on the desk, or you had to go on the field to trade these goods?
I wasn't trading yet. I was more as an analyst supporting the trading group, right? So not only not even the trading group, I was supporting the market making group, because at that time, Enron, like I said, they wanted to create a market. They created a market for a lot of things, anything from energy derivatives, which was their core, to to all of the commodity that weren't readily available on the big exchanges. So weather derivatives, they were very big. They were one of the first ones to trade weather derivatives. There was a desk for that. All the metals, all of the recyclables, they used to trade. So they were making a market, right, for these commodities. And my job was mainly to understand the players within the Brazilian space and provide intelligence, I guess, analytical intelligence to the people who used to make these markets, and find out if it was a time for them to to buy more, to sell more. So I was involved in the intelligence of the trading, not in the trading itself. Granted, obviously I was a recent grad analyst, and they wanted me to, I guess, to put me to work, to gather data and intelligence.
Okay.
But it was an amazing experience.
Okay. Can you tell us a bit about when you left Enron, and what were your subsequent roles after that?
Yeah, so after Enron, so I guess the quick story out there is it's really like the movies. There is a movie. If you guys have you seen the movie, The Smartest Guy in the Room?
Okay, I heard about the book, but I haven't seen the movie yet. So
there is a movie, yeah, very good movie. I highly recommend for you guys to see it. It's a really eye-opening experience. And I think on December 5th, we were there, doing our thing, and we had 30 minutes to evacuate the building. It was literally just like movies in Hollywood. People coming into the floors, give us banker boxes and say, here, through the speakerphone, ladies and gentlemen, please gather your personal belongings. You have 30 minutes to evacuate the building. The company is now closed. everybody was like, "Oh man, what's happening?" So on and so forth. So we all left the building, and the company went bankrupt. Police was there, IRS, locks on the door, everybody kind of on the streets. We went to the bars. So long story short, after I got laid off, I started kind of my banking career over at JP Morgan. I found a position to be on the asset-backed securities desk, collateralized debt obligations, collateralized loan obligations. We were the analysts, so I was still in my analyst phase, looking to get myself on the door on these banks and asset managers, and I found this great opportunity to work for JP Morgan and learn a little bit about that, the securitized, I guess, desk, or the securitized, what is the word I'm looking for? The securitized industry.
Okay.
So all of I don't know how much you guys got into the details, the credit card loans, when we buy the credit card loans, the auto loans. In my case, I was on the debt obligation desk.
Okay. So you were buying debt from the commercial banks and making products for the asset managers, right?
Yes. So not only I was one step after that, because that's the first level, right? When you buy the mortgages and you put those mortgages into a pool, and then you have your first level of securitization, right? That's the pass-through securities. So you buy, I don't know, 100 mortgages, 10,000 people, and you sell that. So that's the first level. So I was on the second level, that when we were buying those deals into another deals. So we were buying the collateralized debt obligations. So it was, the second derivatives of those mortgages. And sometimes they were mortgages, sometimes they could be auto loans, sometimes it could be credit card loans, SBA student debt, student debt, student loans. What else? Yeah, there was mostly in synthetics, which was then we had one deal that was synthetic, which was then a synthetic of the CDOs that we created. So it was the third level from that initial mortgage pool of assets. So you can imagine how much levered was the entire industry, right? You create one product, which is a derivative directly from the mortgage. Then you have a second product, which is derivative of the first one. And then you have the third one, which is a derivative of the second one, which is a derivative of the first, which is the mortgage.
Wow. So that must have been quite risky. So can you tell us a bit more? I remember that at that time there was some monetary policy, and it was incentivized this industry of collateralizing all these debts was somehow incentivized. Can you tell us a bit about what was the environment there and what were people thinking? Because looking from a backwards perspective, it was obvious that it was about to crumble. But I guess that at that time it wasn't clear at all. Matter of fact,
in hindsight,
Alan Greenspan at that time was backing all these structured products, right?
Support. So, it was correct. Go ahead. You can finish.
So, what were the incentives behind all these structured products?
I guess the incentives were to sell houses, right? There's nothing better for an entire country, an entire economy, if you have more houses generate, right, more jobs. So you have that feedback loop. You've got to remember, we are coming off, so ABS's deals or CDOs and mortgage-backed securities already existed. They are not new products. I guess the main problem is when we're starting having derivatives and deals out of these straight pass-through MBS deals, which were guaranteed by the government or the quasi-government, which was the Ginnie Maes and the Freddie Macs or the mortgage agencies. So in essence, you have a government guarantee,
Because
and we were coming.
they were something like double A's and triple A's at that time, right?
Tranches, yes. So those deals, if you think about a $500 million, I was in a desk. We had 4 deals, 500 million each. But in my floor, there were 30 of me. There were 30 analysts, each one of us with about $2 billion or so in my floor alone. And there were multiple floors in multiple buildings doing all of this, let's call the back office of the industry, right? Where we were getting this deal together. We were the trustees, the asset managers. They were finding what to buy. They were raising capital into these deals. These deals were then buying the mortgages, so on and so forth. So the industry in itself was pretty much supported by the low interest rates environment, quasi government agencies backing the credit, and out of these deals they would put, let's say, $500 million, like I said, and they would separate tranches, like more like a mutual fund classes, right? You have the class A shares, class B shares, class I shares. On those deals, they had the same thing, class A shares, and the class A's, B's, C's, all the way to sometimes Z's, and equity tranches. So they would kind of split up a pool of money into, for instance, a class that would receive principal payment first. So when somebody paid the mortgage, when you're paying the mortgage, right, you're paying a portion of principal and interest, right? So that principal would go, that cash flow would go straight to certain tranches, and the interest would go to another tranche. And now you can create numerous types of cash flow situations for the holders of these assets, where you can receive principal first, you can receive principal after, you can receive interest only, you can receive principal and interest, you don't receive anything, you can be an equity holder. So the tranches A's usually were AAA rated, made up of a bunch of high yield mortgages, because that was the nature of those pools of assets, right? Remember, these are all highly leveraged deals with high yield mortgages. People that are usually started where everything starts perfectly. The idea is it's fine in the beginning, and then they started to decrease the standards of lending money, right? So you don't have a job, it's fine. I can still give you a mortgage, pay, a fixed rate for 5 years, and then 5 years from now, if interest rates are lower, you can refinance at a lower rate. Maybe you can take some money out because your house price went up. So this started 2012, 2002, 2003, 2004, and over time, the access was so obvious into that part of the financial system that everything was priced to perfection. Because we got to remember, what is the collateral of all these deals are the house prices, right? Yeah. So it was known that house prices would never go down. And in the movie, again, there's a movie about that, which is The
Big Short, right?
The Big Short, exactly. If you remember, Dr. Burry, the Batman guy, or whatever his name is, I don't know his name, the actor, he's sitting with Goldman Sachs, supposedly Goldman Sachs bankers, and he's saying, I want to buy insurance on those deals. And the Goldman Sachs bankers start laughing. What? Those things don't default, right? I mean, it's a sure. Are you sure you want to do that? Because you're going to lose money. And the guy goes, well, based on popular belief, yes, house prices never go down, but everybody's wrong. And when he does this, the guys from Goldman Sachs start like laughing. Come on, this guy fools. I'm sure I'll sell you insurance. And lo and behold, what happened? House prices jobs start to go down. People couldn't pay loans. House price goes down. And then you have a spiral, right? House prices going down. Collateral value decrease. Now that loan gets called, and they snowballs into, you know, a big problem when collateral prices are really, you know, decrease a lot, and the whole industry just defaults, right? Because of there's nothing supporting other than inflated house prices always going up.
Yeah.
So
So two questions come up to me when we talk about these things. One is, did you have some knowledge that the commercial banks weren't doing their jobs in actually checking whether people were could repay the loans they took? Did you have some oversight on how they did their research? And number two, when did you know that big hedge fund managers like John Paulson, for example, started to invest in securities that would appreciate if the market would have gone down?
they were buying the
Credit default swaps.
I forgot. Yeah, credit default swaps. Exactly. The CDSs on those. That's the whole thing. Yeah, the insurance on those. Well, I was out of the industry when that happened. So thankfully, in a sense, thankfully, because I wasn't, again, for the second time in my career, I wasn't laid off. So I had already moved on to Citi. But I'll tell you one thing. During the time, obviously no one knows. I mean, it's nobody has an understanding as it happening. I remember one thing that we always question as trustees of those deals. So as trustees, our job wasn't to make a claim on the quality of the collateral. If an asset manager found a mortgage pool that they wanted to have inside of their deals, our job was to see if it hit the checklist, right? Unfortunately, that's how it is. We weren't in a position to challenge the quality of those pools. But I remember with my friends, my analysts, that we started like having lunch and saying, yeah, but this is kind of weird, isn't it? How come if you put a bunch of junk, right, a bunch of things that, because we saw many default during the process, not all of the mortgages were defaulting. That's why we had something called over collateralization, which is if you get 100, you get 130,000 of collateral. So you're 30% over collateralized. Just in case things go wrong, you have that buffer. So I remember, where deals were 98% collateralized, 90% collateralized. In other words, the collateral has already been decreasing because some of these pools of mortgages have been defaulting. And I remember in lunchtime we were talking, yeah, but isn't that weird? I mean, all of these junk. Sometimes there was, after the fact, we know, which was called the ninja loans, right? No job, no income. If you put a mirror and if you fog a mirror, you're okay, you're approved. Don't worry about where money comes from. And you start questioning yourself. I mean, now after the fact, it made total sense that the thing was going to crumble. But at the time, it was more like a curiosity than the foresight to really bet against that entire thing. I mean, if I knew what was coming, I would be a billionaire like Paulson today. There was no way for us to find out. But it was puzzling nonetheless to see how those things were operating. And obviously, usually, I guess when you're in your early careers that you stop to really study, there are things that don't make sense and they're wrong. But if you have the ability to know how you're going to bet against those things and how long can you survive to make sure that those things become a tradable opportunity. I don't think anybody in a young, career, not many people at least, would have that ability.
Okay. So can you tell us a bit about what you did after you left JP Morgan, and were you affected by the 2008 crisis in some way?
No, the 2008 crisis, I was already 2 jobs from my JP Morgan job. So very quickly, right after JP Morgan, I went back to credit, and I'm not back, but I went to credit analysis. So uh, I found out about, I told you, I found out what I wanted to do from an early age in my career. And every kind of job that I got, I wanted to make sure that had something to do with, it would help me be in a position to eventually be responsible for investment decision making, right? Either equity analyst, credit analyst, which is, they're both the same, is a different side of the coin, but they're both the same. You use the same tools to analyze things. One is for an equity purpose, and the other one is to lend money. Obviously, the metrics, the importance of the metrics are different, because I want to get paid back my money on a credit, and I want to make sure that there's growth on equity. But the overall thinking is kind of the same. You have to understand the future cash flows of the company. Basically, better yet, you have to understand future free cash flows, because that's where allows the company to sustain its operation and growth, after it pays its debts and obligation to reinvest in itself. So right after JP Morgan, my old boss from Enron needed somebody to work that had experience again with the pulp and paper, and needed to work on the credit side of things. So that was a chance for me to go to a big, recycle company, part of Waste Management, which is the big, trash hauler in the US. I think is the largest trash hauler.
Yeah.
And they have a big operation for recycling. They're the biggest recycling operation. So I got a job in doing credit analysis for the companies that we sold these recyclable products. But then this was kind of any transition between my roles. And then after that, I found an opportunity to work at Citigroup, on the investments side of things, from family and people. It was great. The idea, I said, oh, finally, I'm going to be able to buy some stock, to sell some bonds, to do analysis. And one thing that I realized after my training, well, not realized, I knew about it, but I didn't know it was that much important. And I urge your listeners and your audience to understand, if you have a desire to work with investments, there are 2 sides to the investment, which is, one is the sell side, right? Selling products and services and relationship management. And the other one, which is the investment decision making. So I got myself into a financial advisor position, which is the equivalent to a private banker or an investment consultant. These are all equivalents. And, after you go through the process and you start working, and you sit down to work, and you open your computer and you say, yeah, what am I going to buy today? And you're like, oh shit, I have no money from clients to buy. I can't buy anything. I have to sell. Right. So I knew it, but I was hoping that would be kind of a natural thing, that you are there to get accounts will come, and you have, all of a sudden you have, $100 million of clients to invest money, and I can do the analysis. I mean, it's far from it. There was a friend of mine who made a post these days on Instagram, which was great. He said, if you love investments, a lot of people get into those roles by saying, oh, I want to be a financial advisor. I want to be an investment consultant. I want to be a private banker because I love investments. That's the wrong place. If you love investments, you have to be in an analytical decision-making role. If you are in a private banker, if you are an investment advisor, you have to love people. You have to love selling to people, because that's the role that's what gonna get you successful. So if you love investments, you have to stick with the analytical, which is a much smaller size of available opportunities within the industry.
Okay.
And if you find out that you love people, then you have a much bigger opportunity set to be an advisor, to sell investment products.
Okay. So what I'm wondering, in these kind of positions, do clients value the fact that you have titles, that you have something like the CFA, for example, or? What matters is basically your sales skills?
I, I in those kind of
How
positions,
technical
CFA
is
doesn't matter.
okay?
It doesn't matter. The CFA, it's not a. The Charter of Financial Analyst is not a program for you to be an advisor of families, individual. Unless, of course, you're talking about a family office, right?
Okay.
Now it has a bigger. You as the CFA, it's geared towards you managing pools of assets, right? Managing, analyzing, being in the analytical side of the industry. You will be a much better served if you get the sign the charter, the certified financial planner, or CFP.
Yeah, right.
Which has, you still learn a little bit of the technical side of the analysis for decision making and conversational purpose, but you don't get too deep into the weeds, because it's more on a financial planning level where you got to understand taxes, consequences, how's holistic financial planning, retirement, estate planning, tax issues, liabilities, insurance needs, family oriented issues. So I think CFP and CFA, they have a portion where they kind of talk to each other, but they're more like a complement. But you don't need the charter financial analyst to be a good salesperson. I mean, you don't need any certification whatsoever, because what are you doing? You're specializing in people. I mean, and that's where the things get lost in translation, is because you're really specializing in the relationship. You obviously you have to understand about the markets. You have to be able to intelligently digest the information that's given to you, and put that into a more digestible pieces to your client. But you're rarely, if you are a financial advisor, rarely you are doing discounted cash flow analysis or capital, I don't know, modern portfolio theory, portfolio optimization of portfolio, or dynamic hedging. Rarely, unless you have one big client, two big clients, right? A family office of sorts, a book of $100 million from 3, 4, 5, 10 families, each one of them with $10 million. That's a different story, because you already have the assets to allow you to put to work the analytical part or the CFA. But if you don't have assets, you're better off getting something that helps you bring in clients.
Okay.
Does it make sense?
Yeah, that does make sense. And one other question that comes up to me, you talked about how is it to start from the bottom, that you have no clients whatsoever, and how do you target high net worth individuals, like the ones that you work with, for example, at a Citigroup or a big bank?
How do you target them? Where do you find them?
Exactly. How
that's on you.
Literally,
that's literally on you, and that's why that profession, or that side of the business, that's why they have so many. I mean, that's the by far the largest workforce for any of these big institutions is salespeople, just because there are so many who fail. And they fail not because they are bad for any sort. I consider myself somewhat of a failure at that time, because I didn't want to do that. I didn't want to spend the rest of my life looking after clients, looking for individual clients, and bringing their money in-house, and then giving that money to somebody else within my company to manage when I wanted to manage the money. So that was where I kind of got into that conflict, which is, this is not for me. I want to be more analytical. I want to be within my spreadsheets. I love my Bloomberg terminal. I need to be doing these analytical works. I want to read about economics. I want to read about, industries, and that doesn't help you much into bringing in clients. And how do you target? And that's the secret of the business. It's really how do you really go into your network, into your, your surroundings of friends and families, and how do you, how do you find these executives or these people? I don't think there's one formula. Usually your employer will give you a little bit of a roadmap and support to do so, but that's the secret of the business. That's how, I mean, if I knew exactly how to get them, I would hire somebody to get it for me, because I still don't want to do it. But that's the secret of the business. How are you successful by attracting these people? I don't know. Everybody's different. You have to be a good salesperson. What I hear is you got to listen a lot. I'm the other way. I talk a lot. And that's why I'd rather be on the analytical side of things.
Okay. So can you tell us a bit about when you left Citigroup and how you got to this position where you are right now with your own fund? And
Yeah,
can you tell us a bit about how
sure.
that happened and what were the
So
struggles of starting your own
yeah,
fund?
Citi was an interesting. Was Citi exactly? Citi. Then they got bought by Morgan Stanley, so there was a little bit of transition there between Citi and Morgan Stanley. But when I realized that I didn't want to be in that, in that position for doing that only, I decided to quit again. I mean, not again at the time. I quit because I said I need to do something more market oriented. I went to trade now equity, risk capital on a prop trading desk, and that was the 2008 crisis stint. So right after, so I walked into the office on I think I want to say July, August 2008, right before the things started to get really bad. And one on my trainings, I remember, some of the guys trading, multiples of thousands and making, I don't know, $50,000, $70,000 in a matter of 10, 15 minutes as the market opened. I was like, oh crap, this is pretty cool. I mean, I love this. I like this dynamic. And stay within that dynamic for a while, but obviously it's short-lived. The role of a trader when you're risking your own capital is one thing. When you take in order and you risk firm's capital is another, which is usually many of the positions are usually within risking the company's capital, but then you're less of a trader and you are more of an order executioner, right? You execute orders. Sure, you have your goals, you have your VWAPs to beat, you have your prices that you have to buy it for better than the average price of the day, so on and so forth. But it's completely different than you risking your, you have $100,000. Somebody's going to give you, 10 times leverage. So all of a sudden you have $1 million to trade, and you start, buying, selling throughout the day trades, swing trades, technical analysis, all of those things that we see it, that is really pretty cool. But you realize that, the risk rewards are somewhat not in your favor. And sometimes when, it's not easy to be a proprietary trader, risking your own capital, trading your own capital every single day, living off that. You got to get a lot of resources. So our resources were somewhat limited. We had some good resources, but it was somewhat limited in that sense, to be doing that full time. So I found myself looking for an opportunity to move to New York, to finally move to New York. And I got it into there was an Israeli bank called IDB Bank, Israeli bank in Midtown, who was launching their investment management department. So I was able to get into that initial phase and work with bank clients to kind of put together, bring up the investment management unit of the bank, which they didn't have at the time. So it was a good opportunity to begin something new, and that's where I spent kind of the longest part of my career. And I ended up finishing my CFA, which I started many years before. I finished right as I got into the bank, and I started, co-managing a portfolio of global macro strategies. One strategy was our flagship strategy, which was, global oriented, global macro oriented, and also help out with now individual accounts from private bankers that needed help with building portfolios customized to their clients. So 10 years on that, it was a great school. It was an opportunity, like I said, to really put to work my what I've learned. So I got into a place where there wasn't much going on in terms of an investment unit. And I think that was the beauty of it, because I was able to at least contribute a lot to create the department. There was no, bias. There was no systems before where would have to, redo things. So it was really starting from scratch. And 10 years later, I said, enough is enough. I want to do my own thing. Now I quit for the second time. And I finally, got the courage to open my own firm, which is now a New York registered investment advisor, and doing mostly global macro long short strategies. And we are, working a couple of deals to bring in partners to help with the relationship part of the business, which by now that is not my intention. So I have equity partners coming in and doing that part of the business.
Okay. So can you tell us a bit about what are the requirements to start your own firm, and what are the kind of thresholds where you start to break even in a firm like yours?
Sure. Yeah, the requirements: a lot of guts, a lot of courage, be willing to work extremely hard for so many hours. Forget about sleeping anything more than 4 or 5 hours. Do everything. The requirements are giving your soul. Now, financial requirements, which is a different story. It's not prohibitive if you have the ability to support yourself, right? That's the main thing. If you really can spend a year, 2, 3 years without having any income, pretty much, and just building your track record, investing, friends and family's money, proving your strategy, that's the requirement, right? So if now that comes from the opportunity cost of not being out there working, right? So instead of getting a salary working for one of the places that I worked in the past, it's kind of not taking any salary, putting back whatever you're earning back on the firm, because you want to always be getting better and better resources to do your job. So usually break even, and now the traditional break even for firms is going to be somewhere within the $30 million. So okay. This way you can now, have your Bloomberg terminal, if that's, for me, is a requirement, right? I know what to do with a terminal that I require to have one to be able to do what I do, right? Some people might not see that necessary, but for me, with not spending $40,000 a year or so, or whatever is the cost that you have at market data and so on and so forth, it will really hurt my ability to provide the intelligence that I know how to provide to a pool of assets. Can I live without it? Sure, anybody can live without your tools, but it's kind of hiring a surgeon. You're a hospital, you call a surgeon to come in and do brain surgery, and you give him, a dull knife and a syringe and say, here, give some anesthetics to your patient, cut his brain and figure out what's happening. The doctor's going to say, well, I can do that. If he's dying, I can probably, cut up his scalp and see if he's in an emergency situation, but it's not ideal, right?
Yeah.
So the tools now really help do the job, to be able to provide the intelligence.
And I think it's kind of hard to have an edge if you don't have even the benchmark tools, right?
Correct. I mean, exactly right. So how do you find your edge? How do you create if you don't have the basics, right? The basics necessary for you to at least be seeing the same things that everyone else is that's competing. So that's kind of that's the entry fee. That's the entry price. Now, the other entry price is obviously the intellectual capital that you have to have, right? Which in my case, it took me 20 years of studying, learning, experiences. I mean, either you know what to do with it or you hire someone to do it. Now, if you hire someone to do it, that's when the price goes up. So that's the $30 million. Now you're like, well, you're doing yourself, or you're probably paying somebody. Are you paying an analyst? You're paying somebody to bring in assets. Now you have an office. Do you need a physical office? Nowadays with COVID, everybody can work from home. I mean, I have a better setup here now at home than many people had during the COVID, big firms. If you think about it, a guy that was working at Goldman Sachs, he's probably in a small 1-bedroom, on the background, you see his bed, or the Bloomberg analyst guys, in the kitchen with a laptop in front of it. And nowadays we're still in a home office here. So nowadays I have I have my own office. So I have a bunch of things and which helps the leveling out the playing field, the Zoom calls. I don't need to be traveling to Brazil as much. I can meet clients on Zoom. And once the deal is about to be closed, I can, dislocate myself. So the barriers to entry are really intellectual capital. I mean, you got to know what you're going to do with it, and some basic softwares that will allow you to create an edge, to find a solution, and have that and market that solution to people that are looking for that, for that solution.
Okay. So I have a few questions that come up to me. So one thing is, what are the realistic fees that a fund like yours can charge? I mean, I think that probably Carl Icahn or Bill Ackman can charge more given their track record. But what are the realistic fees that a fund like yours can charge? And another thing is whether a fund like yours are investing more on alternative data sources, and are some of these alternative data sources like the satellite data becoming more of a benchmark?
Yeah, the fees that we charge. Well, first of all, we are a managed account. We provide the difference between a fund and what we have mainly is, think about it, we have multiple funds, which are not necessarily funds, they are individual managed accounts. So clients, in my case, clients open up accounts and we have the ability to trade each account separately. It's what the industry calls separately managed accounts. So the difference between the fund is now everybody puts the money into a fund and you trade one vehicle. In my case, I have multiple accounts, each client with their own strategy, if you will. Now the fees are industry standard fees for asset managers. Usually you can get away with a little over 1% or so, but anywhere from 75 bips to 125, I think it's fair game if you have a strategy that has been proven to be consistently within better than your benchmark, so on and so forth. Now you can still charge, I can still charge 220 fees if that's the standard, right? Whatever is the fee that I would like to charge, it has to do with whatever kind of returns you're providing your clients. So for the alternative space, so one of the things that I did, right, after I opened up my firm, I knew that I in order to compete at the higher level, I needed to upgrade my skill set, either myself or finding partners that will allow me to compete at a higher level, or at least to show clients, prospective clients, if you will, something different, right? So in other words, there is somebody interested in buying my strategies, and if I tell them that I'm going to buy, let's buy some Disney stock or let's buy some Apple bonds, they're going to look at me and they're going to probably laugh and say, Leo, I already have that with my Merrill Lynch guy, with my TD Ameritrade, with my UBS guy or Credit Suisse, whatever you are. So I knew that, and so what I did then, I was able to put together my strategy, my kind of the foundation to the firm, the flagship strategy, which is the one that I pretty much worked on in my prior employer, which is this global macro long short strategy. But I went out to find out, like I said, either increase my skill set or find out partners that could bring something different to the table. And I found a very unique, incredible piece of technology through a common friend over at the CFA New York, CFA Society of New York. This was back in 2019 when I went to Toronto, where his headquarters for this firm is. It's a quantitative shop. It is still a purely quantitative shop, doing incredible piece of analysis on the behavioral of market participants, on the behavior of market participants. And it really resonated with me because my CFA, a lot of things that I've learned through the CFA, being technical analysis, being mostly fundamental analysis, but being a equity trader and understanding, technical analysis, I always felt that there was something missing to the entire decision-making, I guess, process, which was the behavior of finance, right? The behavioral aspects, it was always present. Everybody says, yeah, people, they have these biases, right? The hindsight bias, confirmation bias, all these biases are very present into the trading. And I always I've always liked it to study the behavior, rational, efficient market hypothesis. In this firm in Canada, they were doing scientific research for over 20 years now on the behavior of market participants. And when I started looking at their technology, I was completely amazed by it. In 20 years of my career, I have never seen anything that detailed and that quantitatively driven, that's the more important thing, is quantitatively driven behavioral analysis. I'm not talking about neurolinguistics, social feed, Twitter, number of words that are being thrown out there. I'm talking about statistics, probabilities applied to the behavior of market participants, which is extracted from the dynamics of the order book. So for your audience who don't understand or are not aware of the order book, so the level 2 quotes, usually you have the level 1 quote, which is the bid and ask, right? That's where people buy and sell. But then below that, you have the book, right? The order book, which is usually limit orders. And that's where we are analyzing everything that happens below the price in those level 2 quotes and on the books to give ourselves an edge into identifying inflection points into the price intraday of whatever instrument is traded on an exchange. So it's a handful. It's a big concept there.
Okay. So another thing that comes up to me. So if you want to talk about a bit this company that is QuantGate Systems, right?
Yes, that's right. QuantGate Systems.
You're free to do so. And another thing that I'd like to ask after this is what is the realistic track record you need to have in order to attract institutional capital rather than just private people?
Sure. You're talking about at least 3 years of audited, results. I am getting to my 3rd year now in December. So December 2018 is that when we launched. So I'm going to be completing my 3 years, and I'm going to be then hopefully opening doors for some institutional money. But that's usually the requirements. Can you find it? Can you do it with less than 3 years? Yes, you can. There's no rules, there's no regulation, as far as I know, that requires you to have 3 years. Usually it's going to be a checkbox that they're saying, well, if you don't have 3 years of track record, it's hard for us to analyze. But there's nothing saying that a desk that needs to deploy, the guy's sitting on, I don't know, $1 billion of capital, of risk capital, and they need to deploy 1%, less than that, 10 basis points, they cannot do it. So
Okay. Yeah.
usually 3.
Okay.
Yeah.
Okay.
So
Okay. So, how did you get involved with this company, and what are the products that they are developing right now?
the QuantGate story. So it was, like I said, a common friend. He wanted me to check the company. I was building my firm. I was building the flagship strategy. I didn't have any time for quite some, many months. I was kind of focusing on building my process, identifying my edges, making sure that I had any edges whatsoever. And after some time, I decided to kind of go there and learn about the whole story. And like I said, it kind of really fit into the DNA of my company and the DNA of their company, QuantGate, which was behavioral analysis. Currently now so that is a pure technology company, right? That's kind of the way that we are working together, is that they are a pure technology company. I'm one of the executives of the company. So, and I can use my advisory firm to license the technology and then create products. We are still trying to seed one of the products. I hopefully now, with the deals that we're trying to get from Brazil, we have the ability to seed one of these strategies to trade as a hedge fund. Not a hedge fund. It's going to be a private fund that will use 100% of their technology robotically to trade intraday futures, mainly the S&P and the NASDAQ and the Russell futures here in the US. So they do have it's one intelligence. That's what it is behind. It's like one brain. And QuantGate now has 3 lines of products that use this powerful brain, this powerful technology, which is the ability to foresee, literally forecast and identify short-term, anywhere from 5 to 15-minute time horizon intraday inflection points based on real-time data extracted from that order book. One product, it's available on the app stores for people to download. Your audience more than welcome to try for free. I believe you did try. Did you have some problems? I thought you told me you had some problems in your market.
But I saw how that works. That's cool. I didn't get the chance to try to trade based on that information.
Okay.
Yet, but I will.
But you studied a little bit. So yeah, let me know how does that go. It's on the App Store. It's a mobile version called Pilot Trading. Now we have a pro version, which is called Stealth Trading. Now that's a little more like a desktop downloadable on your machine, where you get all the signals, all the information in a little more granular format. And the third product is the API connections, which that has a lot to, that has the opportunity to really, go crazy, because it's really us delivering our intelligence, QuantGate's intelligence, into whatever firm wants to consume that information and then use it for trading on their own, right? So that's part of the alternative data set that you referred earlier. I think you talked about satellite images.
Yeah.
Right. As one of them. In our case, would be behavioral analysis, right? Market participants' behavior data set based on probabilities, quantitative analysis of the order book. That would be the alternative data set.
Okay. So another thing that I'm wondering, one of the last things I wanna talk about for people that want to break in your field, are big hedge funds hiring straight out of college, and what are the titles that are that people like you look for? Are you looking for other CFAs, or are you looking for people with a more quantitative background?
I think to break on the decision making sector, right? Because that's what you're referring to. You want to
Yeah,
be, call it a hedge fund, call it a mutual fund, call it a private fund, whatever it is. You want to be in a position that you participate. Probably it's not going to be you alone, right? You're going to be an audience or a member of an investment policy committee for your firm, for the firm that hires you. So if you want to be in that position, the skill set nowadays, it's becoming ever more quantitatively oriented, right? When I started, I do have my Visual Basics, capabilities, my VBA Excel, but obviously that got limited, right? It's still limited today. I mean, it is limited today, given all the, especially Python that has been, making a lot of ways into data analytics. I can A lot of things that I use for my data analytics, I can get pre-chewed pretty much through my Bloomberg terminal, and I can still survive with my VBA coding, which it can still be very powerful, right? It's somewhat restricted in itself, and Python has a lot more flexibility, a lot more ways that you can integrate data, database management, SQL, Python, so on and so forth. So yes, you should be, if you want to be in decision making, you should be looking for these hard sciences or hard math skill set. Said that, that's not everything for you to be a good analyst or a good investor. I mean, you still have to have some of the soft skills necessary to be able to identify trends, right? To be able to look at things in a way. You don't want to be a computer, a completely programmed person, because I think that's what misses from some analysts. Maybe somebody doesn't have the quantitative skill set, but that person has a sensibility for things, which you can acquire that now through social experiences, living different places, many different ways. Case in point, I'll give you right now the different a simple way to look at it. Now, this past weekend, I was traveling down on Turnpike, and we were going to an event, South Florida, and I'm in Florida now. So New York became a place to go again. Since COVID, we found ourselves here in Florida, more precisely in Orlando. So this weekend I was going to Miami, South Florida, and for the first time, I haven't been driving much again, but first time I'm down the Turnpike, and I knew FedEx stock has been down quite a lot, from $300 to 220, 212, whatever it is today. And reading over the news about competition, so on and so forth. And the first time that I saw two Amazon trucks, right? I'm not talking about the trucks that goes within city. I'm talking about big semi trucks, going from distribution center. Two of them, I saw 0 FedEx trucks on the road. And why do I say that sensibility? It's like, well, crap, look at that. FedEx is probably losing market share to Amazon. As soon as you see also Amazon airplanes flying, so Amazon now is getting horizontal on the space, and now there's no need. Sure, I can do a data analytics and understanding how many more pieces of boxes they will lose, so on and so forth. But before that, right? But by simple observation, I now creating some kind of investment thesis, which I can prove or not through data mining and data analysis. But if I don't have that perception, that sensibility, you might pass us by, and until you really comes obvious to you, is kind of too late. This is probably too late, but I'm just trying to give you an example of how you can use.
I think Ben Graham, back in his days in The Intelligent Investor, said that average people can have an edge on Wall Street just by going to the supermarket, for example, and understanding what products are getting sold more than others,
Yeah.
and so on. And that can
yeah.
give you a starting idea.
Look, that's the guy you're talking about right here, right?
Yeah, you're right.
That's one of them, and it's and one of those is saying that we go to the shelf space and you see, well, how many? I mean, and that's putting the investor lenses, right? Once you understand about the industry, everything that you look at it becomes now a possible trend, or is that a fad or not? So you go to the supermarket, who's on the top shelf? I mean, what products are on the top shelf? What products are on the bottom shelf? Who's on sale every single time?
Yeah.
Right. And you go in front of I don't know in Italy what are the stores, but here in the US you go to a Bed and Bath and Beyond or a Best Buy. You probably know the names from
I know that.
companies. And you realize, well, the parking lot, the satellite images. I mean, I don't need satellite images to tell me that the parking lot is empty, right? I can see it. Obviously, it's nice to have, and I can look across the US. But if I go inside and I see no one, the stores doesn't look, appealing. And this is the consumer, right? Now, exactly right. If you develop that sense, I think mosaic theory explains that very well, right? And you probably studied that, that's what we're doing. We're trying to put together the pieces of the puzzle with publicly available information, right? Nobody wants to be caught on the Billions episode of trading, insider trading, which that exists, by the way, right? If you believe that that's not true, I mean, I'm 100% sure that everything there has a moment of truth behind, but that's really the mosaic theory, right? How do you put together all of these things and come up with a good enough thesis that can be proven or disproven through data analysis? I think you are much better off than if you are a very good data miner and you have the ability to mine the smallest of the smallest detail, which generally speaking, on the margins, it won't make a difference, right? So that's the well-rounded kind of person that I believe funds and firms are looking for. And you only have developed that through experience, time, and sitting down and studying.
Right. So I am done with the questions. So I really want to thank you for your time and for your availability.
Yes.
It was a lot of fun hearing from you or your experiences. So thank you a lot. If you have anything else you want to share, you want to say something to the people that want to get into the field you're in, you're free to do so. And thank you again for your time.
Thank you. I want to thank you for the opportunity to share this story. Like I said, it's not usually the typical story that comes across, especially being an immigrant here, going through the hard times, but proving that it can be done if you really set yourself to that. If anyone has, in the future wants to connect, feel free to send me a message, email. I think you can put it on your channels. If you want to follow, I have an Instagram. Actually, I'm a lot more active now, granted a little more in Portuguese nowadays, but I'm working on to also have a lot of English content on the Instagram page, which is
I can link it in the description for the people who are interested. So
you can do that. It's leocardoso.cfa. That's the handle. But please, if you do that, and looking forward to hear some feedback from your audience. Please, more than welcome to connect.
Okay, so thank you a lot. This is it for today. I'm Giacomo. This is Also Hub. See you next time.
Thank you.